All right, welcome back. Today we're going to be going through accounting, COMM 293, reviewing the entire course up until the midterm. We got a lot of slides to go through, but we should pretty much cover the entire course up until now. So one of the larger parts about accounting is the dealer equation. So this is basically taking from your assets equals liabilities plus equity and kind of expanding that out a little bit. And basically this is kind of showing what you debit, what you credit. So on the left is your dividends, your expenses, and your assets, and then the left, well, liabilities, equity, revenue. Only thing to keep in mind is the E's on the left is expenses, on the right is equity, and everything on the left, the normal balance increases with the debit. Everything on the right, the normal balance, it increases with the credit. So that just means you're going to credit that to increase that number in those accounts. And you can kind of remember that for dividends, D for debits. So just a few examples here of how that would kind of look like increasing these accounts versus decreasing them depending on debits and credits. Again, just keep in mind DEA equals LER and you should be good. And just keep in mind expenses are going to be on the left, so they're going to increase with the debit there. Okay, with this, between all of your debits and credits, you have to ensure that after you debit or credit one of them, you're balancing it out. So if you are to debit one on the left, you either have to, so you're increasing one on the left, you either have to increase one on the right by crediting it, or you have to kind of switch it up and cancel it out by increasing it as well on the left side. So you're either going to have to debit and credit one on the left to balance that out. So you're increasing and decreasing on the left, or you kind of increase both left and right. Just keep that balanced out like a balance beam. And this is just to always make sure that debits is equal to credits. That's kind of the holy grail of accounting, is making sure that everything kind of equals each other. So, you know, when you have your debit, depending on if it's on the left or right, you have another credit, and that's going to balance out. And that's just with every journal entry, just keep that in mind, and you should be good to go after that. Speaking of journal entries, just some basics to keep in mind. One, you always want to start off with the date. So you're going to start off with the date, and then you're going to start with the debit. And then following the debit, you'll have your credit, and then the credit is indented a little bit, as you can see here. And then you kind of have your numbers there. And once again, the sum of your debits is going to equal the sum of your credits. That balancing is extremely key there. And then once you've done kind of all of your journaling, you're going to post that to your different T accounts. And this is just basically showing a list of all of those debits and credits that you've had. And within each T account, it doesn't have to exactly be equal. So as you can see here, our debits don't equal credits within our supplies account. But then across all of these different accounts, they have to balance out. So it doesn't matter within a specific account, it doesn't have to be balanced. But after you combine all those accounts, you need debits to be equal credits. If for some reason debits do not equal credits, you made a mistake, that's wrong, something messed up. So across all accounts, if they don't add up, something's wrong, fix that because it's bad. And this is basically what we call a trial balance, is just to see if all of our debits equal all of our credits across all of our accounts. Okay, so with this kind of trial balance, we have this balance sheet, which essentially is a slice in time. So it's a snapshot, a picture of a business. And it kind of is posting up all of these kind of permanent accounts in order of liquidity. And it kind of starts with assets, that goes to liabilities, and then goes to equities. The big thing here to keep in mind is that assets equal liabilities plus equities. So assets is basically what the business owns, what gives it value, right? So these can be things from equipment, buildings, supplies, everything like that. And then how does it get that? So part of it is through debt or liabilities. So basically it gets money from other people, and then they get a claim on those assets. So if I were to go to someone and say, hey, you know, I want you to lend me $1,000 and you know, I'm going to use it in this business, then I owe them, they have this claim on that $1,000 of my business. So that's kind of the liabilities claim on the assets. And then anything that's left over, this residual claim, is the shareholders' equity, the equity. And this is basically like, let's say if I myself were to put my money into the business, or the business generates money through retained earnings, that's kind of left over. So all of these kind of debt holders, the liabilities, they don't have a claim on that asset. It's kind of additional stuff. And you just have to make sure that your assets equal your liabilities plus equity. So you can add those two up. It's basically explaining where your assets are coming from. So part is from the money that was invested run through liabilities, through kind of that debt. And then the other part is either from generated revenue, retained earnings, or shareholder investment into the company. So similar to the balance sheet, we have the income statement, and this is just the evaluation of a company's performance over time. So as opposed to the balance sheet is a snapshot, kind of like a freeze frame. The income statement evaluates over a period, so it could be a quarter or even a year. And it's used primarily to kind of measure the profitability, see how well the company is doing. Is it generating income? And it's essentially showing where the revenues and expenses of a business are going. And just real quick, revenues are basically it's business activity that a business does to generate money, and then expenses are basically either part operations to generate that revenue and also just part expenses associated with generating that revenue. So just keep those two definitions in mind there. And another big topic is this thing called accrual accounting. So it sounds really complex, but essentially all it means is that you're recording transactions when the business activity happens. So if I were to chop down a tree, I'm not recording this business activity before I chop down the tree when the tree is growing. I'm only recording it when I'm chopping it down. And this is true for both revenue and expenses. So we'll get to a little bit of like what happens when it's recorded beforehand, but you're only recording it when the company provides value for revenues, and then again, expenses are only recorded when they're incurred. So you have kind of inventory, so you buy supplies, and then when you use them up, then they turn into a supplies expense from an asset. So you're really only writing down things when the business activity has occurred. That's a very key part, and that kind of is what affects adjusted trial balances, which we'll go on to. So again, this is what happens. Let's say before we get paid, we do our business. So these are called receivables and payables. So receivables is we get revenue, but we don't get the cash yet. So these would be things like, okay, we do a job, it's almost like an IOU, someone's gonna pay me, but I've already provided that service. That's kind of considered an asset. And then the flip side of this is a payable. So let's say that we have an expense, but we haven't paid, the cash hasn't left our balance yet. This is gonna be a payable, and these are both accruals. So this is when the business activity happens before the dollars change hands. So just keep that in mind. And then the flip side of this is when I give you money before the business activity actually happens. So this is unearned revenue. So basically if someone pays me and say, hey, I want you to chop down a tree in a week from now, I can hold on to that cash. This is unearned revenue because I haven't earned it yet. I haven't done anything to deserve this money for not chopping down a tree. I can just sit on my butt. So that's unearned revenue. So we get that cash, but it's unearned revenue because we haven't performed the service yet. And then similarly, but on the expense side is a prepaid expense. So this is basically if you're paying, so okay, one good example is kind of rent. So before you use your building, you pay rent. And this is basically before you're using up this expense to generate revenue, you're paying for it. So your cash is changing hands. And because we have kind of this accrual and deferrals, we have to have these adjusting entries. So this is basically over a time period that happens. We might have collected some of that cash in the receivables, or you might have performed that service to generate revenue, and then we have to keep track of that. So we're changing we have that cash, and now we're changing from unearned revenue over to revenue. And this is basically to convert these accrual or deferrals to revenue or expenses. And it's just recorded to update all of the business transaction that has happened over a period, because otherwise, we'd get cash from people who owe us cash, but we haven't recorded that yet since it's still a receivable. So it's just taking down those receivables and then increasing our cash and revenue when that has occurred. So just a few examples here. You can kind of take a look of kind of the different areas. So the first part is kind of what happens before. So these are the accruals and deferrals. And then the bottom bolded part is kind of these adjusting entries. So for example, for payables, you're going to decrease by debiting your accounts payable, and then you increase your cash because you receive the cash from the people who owe you money. Okay, so this is also another key point is, let's say I prepaid for rent 24 months in advance, but my quarter ends my year end is 1 year. So I've only actually used up half of that rent. So you kind of have to keep in mind the numbers, and you divide it out evenly. So if you're paying you prepaid it 24 months in advance, and then you're looking through for an entire year, 3 months in this situation, you divide it out evenly between how many months you've paid so for 24. So that'd be 250 kind of divided by all 24. And then you're adding those up for the amount of months that you've used it. So for 3 months, you add up 250 divided by 24. those 3 times, and then you're just essentially saying, okay, this is the expense because you're using it up, and then again you have to decrease um, your prepaid rent, your deferral, because that's decreasing because you've used it up now. So once you've used it up, you have to decrease it, and then on the flip side, now it's an expense. So pretty simply for deferrals and accruals, for the adjusting entry, all you're doing is just showing, okay, I've used it up, so you have to decrease that, and then you're increasing whatever it is, like an expense or a revenue once that has happened, or cash if it's the accrual. Okay, so depreciation it's not the value of your current assets. It's not what their resale value is. Essentially, it's a way to spread out an asset or equipment over its useful life. And we normally use the straight line method, which is pretty much you take however much that equipment costed you, and then however much it can, when its salvage value, at like the selling price after its useful life, and then you divide that by its useful life. So if you had a machinery that could last you 10 years, it costs you 100,000, you could sell it for like $10,000 after you use it up over 10 years. You just do that quick math, and then you find out, okay, each year it's depreciating by this amount, and that depreciation goes into this thing called accumulated depreciation, which basically is just a way to show, okay, yes, we have purchased this asset, this equipment for this much, and then it's a contra asset account, which basically means that for an asset, the normal balance is to debit it to increase it. For a contra asset, it's the opposite. So for any contra asset, it's the opposite of what its contra asset is to. So for asset, the contra asset to increase it would be crediting it. So you have your depreciation expense, and that flows into accumulated depreciation, and that just kind of shows over time what is that true value of equipment as opposed to just reducing it, just because equipment for the most part costs way more money than supplies. So we want to keep track of of how much we've kind of spent on that equipment, and where kind of that money has been going. So that's why we kind of keep accumulated depreciation as opposed to just reducing our equipment, because otherwise we wouldn't really know the value that we spent on equipment, and that's something that investors like to look at. And that's the main point of accounting or financial accounting, is to kind of give a picture of how a company is doing for investors in order to transfer the flows of information and funds between kind of companies and investors and debt lenders. And they want to know those type of things. And again, it's very similar to supplies. So supplies, equipment, one is used up kind of quickly, the other lasts a long time. So you can think of like, things that you have to build together, use it quickly. It's either go into inventory, and the other is like machinery, plant, property, and equipment, that kind of larger general thing. And the only difference here is that with this, we're reducing supplies. So you can see for supplies, we don't really care. It doesn't cost that much. It's not that big of a deal. So we don't matter. We don't have to track how much we spend on that. But versus equipment, and everything that we depreciate, we really want to know how much we spent on that, which is why we have accumulated depreciation. That's the only difference. It's just we can keep track of how much we spent on that, as opposed to just reducing supplies as we do on the left there. So yeah, it just shows you how much the company is investing in equipment, just because, again, investors just want to know that sort of stuff. Okay, so once we've done all these adjusted trial balances for the accruals and deferrals, then we put it all into this thing called the adjusted trial balance, which is basically the same thing as the trial balance that we had before, where we're balancing all debits and credits, but now we add in all of that business activity or cash that has changed hands. And once again, you want your debits and credits to be equal here. So as you can see, we've added in red here all of the potential things that has happened from these accruals and deferrals. So you got your like accounts receivable, your prepaid insurance, all of that. It's kind of like a safety check, just to ensure that you're doing everything right and that everything has balanced out after you do your adjustments. So many safety checks, they don't want you to make any mistakes in accounting. So another safety check we have here is the adjusted trial balance. Again, what are you checking for? You're checking for debits equaling credits. Those add up, you're good. If left equals right, you're good. Speaking of left and rights, important thing to keep in mind is where debits and credits go. So debit's going to go on the left, credit's going to go on the right. Just keep that in mind. Maybe there'll be a question about that. Okay, so a little bit of a difference between cash and net income. So there are a few things that can affect cash and not affect net income, a few things that can affect both, a few things that can affect net income. just keep in mind that there are different things. So your net income does not equal cash because you have things like receivables, you have things like payables, which can adjust it. And let's say you purchase supplies. So you purchase your supplies with cash, but supplies are considered an asset, so it's not affecting your net income. But then when you use your supplies, then that's going to be an expense, and that's going to reduce your net income. And there's just a few other examples of where cash and net income are different, and just keep that in mind. There's a little bit of difference between net income, which is the income that a company is generating, versus the cash that it's generating with its cash flow statement. Okay, so another thing to keep in mind is these things called temporary accounts, and essentially they accumulate over a period, and then at the end of the period, you have to make them all equal 0 because they're not carrying over, they don't carry over. We basically reset them to 0 through debiting and crediting. They're kind of reverse normal balances, and then all of those flow into retained earnings, which basically just shows, okay, how much money has the company generated over time. So a few different examples of temporary accounts. So we have revenues and gains, expenses and losses, and dividends, and then there's a few kind of subcategories to these. But basically at the end of the period, all of these are zeroed out, and then they move into retained earnings. How do they move into retained earnings? So first we have our prior retained earnings. So this is basically like if we had a bucket and each year we're filling it with water. We take that level of the bucket, that's our retained earnings, and then we're going to add in our revenue because this is kind of the money that we've taken, and then we're going to take out our expenses. So we're kind of getting our net income there, and that's so what's added to the bucket. But then we also might pay some of our shareholders, so we take some water out of that bucket in forms of dividends, and then we pay our shareholders. And what's left is our retained earnings for that year. And we have to zero out all of our revenue gains, expense losses, and dividends to make sure that that equals out, because we don't want them to carry over. We don't want to see, oh, we accumulated losses over the years. Those just go into retained earnings as kind of one simple whole number that we can be used to evaluate the company. And just really quick, for shareholders, these are owners of the companies, so they've kind of invested equity into the company, versus debt holders or lenders. These are people who have given money for liabilities, so they have a claim on assets. Shareholders do not. They have the residual claim, so anything that's left over, if a company goes bankrupt and has to sell off its assets, the people who own the liabilities will have first dibs on that, and then anything left over, the residual, goes to the shareholders. So as you can see here, it's just an example of how do we close this account. So as you can see, we have service revenue. Okay, so this is we credit service revenue to increase it because it's on the right, and then kind of to balance that out, we have to debit it. Just kind of make it even there. So you kind of zero it out, as you can see here. So service revenue, you have to debit that, and then it basically just makes all those temporary accounts 0, and then you send all these numbers depending on if you're adding or subtracting it to retained earnings, and you send it through. And that just kind of, if you're thinking about your bucket, you're either adding water to the bucket or you're taking it away, and then all of your temporary accounts are going to be 0, reset, ready for the next year for all of the business activity that's going to happen. Okay, so now that you've done that, now we have kind of another safety check, because we love that, but essentially, or not necessarily a safety check, but this is just kind of a snapshot of the company. It's called the post-closing trial balance. So we add that calculated retained earnings, prior retained earnings, plus what we just calculated to our trial balance, and then this is kind of essentially gives you the same information as a balance sheet. It's a little different because this is for internal use versus a balance sheet is external use, but it's pretty much the exact same thing, and it's just kind of showing all these different permanent accounts as opposed to the temporary accounts like the dividends, the revenues, the expenses that we talked about before. Okay, so we have all of these safety checks. What happens if we make a mistake? That happens. So we have correcting entries to readjust and fix these mistakes. So different kind of questions you can get asked is, one, what should the entry have been? And then what is the correcting entry? Those are kind of the two questions you might get in terms of correcting entries. So one is, let's say, like you recorded service revenue when it should have been accounts receivable because the business transaction kind of hasn't occurred. And first you make the error, and then how do you identify it, or how do you change it? So what it should have been, you're basically having to debit and credit. So you're going to reduce what was actually added. So in this case, the service revenue, you're debit that to reduce it, and then you're going to credit accounts receivable to increase it, just to fix it up. And once again, you have your debits equaling to your credits, and it balances out. So essentially, to to adjust it, whatever the mistake was, you're kind of going to do the opposite to reduce that mistake, and then increase what the actual proper entry was. Okay, so how do items get from one place to another? Through shipping. Two different methods of shipping is essentially all just when the ownership of whatever you're shipping changes hands. So one is called FOB, shipping point. This is where the ownership of the item changes hands at shipping, versus the other one is destination. The ownership changes hands at the destination, and whoever owns the asset or the thing that's being shipped pays for the shipping. So the buyer in this end on shipping point would pay for the shipping, and this is journalized as a debit to inventory, just because we wanted to inventory costs to accurately reflect how much we paid for something. So shipping costs is essentially included in this inventory. So if it costs us $2,000 to ship, that would debit to inventory to increase that, just to accurately reflect the cost that we've paid for that. And then on the seller side, for if they were paying shipping, they would record it as shipping expense, and we would just record that as our supply or our whatever we're shipping as being more expensive, because the seller's going to be like, oh, this is costing me $2,000 to ship in shipping expense. I'm going to jack up the price by $2,000. So once again, it's going to be reflected in our inventory costs because we purchased for that. So that's just all this is keep in mind, we want inventory to reflect the actual cost that we've purchased for the goods that we're buying. And then with kind of shipping, changing hands, things like that, they have this little thing called kind of discounts and payment terms. It looks a little confusing, but essentially all it means is that first number is going to be your discount amount as a percentage, so 4%. And then in a time frame, a certain time frame, so, and this means it's 10 days. So this means that if you pay within 10 days, you're going to get a 4% discount on whatever you're buying. If you don't, net 30, you have to pay it in 30 days. Otherwise, bad things will happen. So don't not pay. And if you pay within 10 days, that kind of increases our receivable turnover rate. So it's good for the seller because then they get cash and can continue their operations more smoothly. So that's kind of why they incentivize people to increase or to pay sooner. So they get a little bit of discount, a little bit incentivized. And that's essentially all this is saying, 410. You're getting that 4% discount if you pay within 10 days, and then kind of calculating that. From the buyer side is, once again, you had a payable, so you had account payable owed to the seller, and then if you do pay it in time for the discount, it's going to be reflected as a credit to inventory, because rather than having to spend $150,000 cash, since you spent it before, you get a little bit of a discount, so you only had to spend $140,000 cash. So again, we want inventory to reflect the true cost of what we paid for it. So our original entry is we debited inventory for $150,000, so that was our cost for it. But then since we had the discount, then we have to reduce that by the discount because we didn't actually pay that full amount. So that's why we're crediting that, and then we'll have our inventory be $144,000 there. So that's reflecting the true cost, the cash that it costed us. And then on the flip side, the supplier side, this is just recognized. Okay, so we received $144,000 cash, and then we also had a $6,000 sales discount, and this is kind of a contra asset as well to revenue, and this kind of can add up to your account receivable. It's just, again, be reflective of kind of what you've been selling. And so sales discount is a contra asset account to revenue. So the opposites, debit and credit, matter for that one. Yeah, once again, we want to just, again, accurately reflect how much we spent on inventory. That's the whole idea here is we want to know, okay, whatever we have in stock, how much did it actually cost us? Okay, so then what happens if we buy something and then we have to return it to the seller, or vice versa? Again, from the buyer side, this basically means like, okay, you're going to be reducing your account payable because you no longer owe that, and then you're also going to be reducing your inventory because you no longer have that inventory. And then from the supplier side, you're getting that inventory to you, so you're going to increase that inventory through debiting, and then you're no longer getting that, you don't no longer have that account receivable, so you have to decrease that. So that's where these debits and credits are coming in. So it's basically just the flip side. The buyer returns it, no longer has to pay. doesn't have the obligation. The seller now has that inventory, but no longer has that receivable. Okay, so within inventories, how do we track them? Two main different ways. One is periodic. This is like kind of every so often, and then one is perpetual. So this is constant flow, checking, kind of just as much as you can. And one is more time intensive, takes a lot longer. So it kind of depends on how many items you're selling and what you're selling to kind of decide which one you want to do. And then, yeah, so one is just calculating at the end of the period, and the other is continuously checking. And so this varies when you're recording COGS. So and that's cost of goods sales. So this is cost of goods sold. So this is basically like how much it has costed for like each kind of product you're selling. What's the cost of that? So for periodic, you're recording that at the end of the period, and revenue you're recording at, again, when the business activity takes place. But then for a perpetual system, since you're tracking things continuously, you're recording your COGS also at the time of sale, as well as revenue, because that's when the business activity occurs. So the only difference there is when you're recording COGS, and how often you're kind of tracking your inventory. Yeah, okay. So inventory in itself has a little kind of calculation here. So you take your beginning inventory for a period plus everything that you've bought, and that's going to equal COGS, which is basically what you've sold, the cost of your inventory for what you've sold, plus whatever's left over. And then this ending inventory is going to flow through over to the next term and be your beginning inventory for the next term. Keep that in mind because that's a little bit important there. But there's a little special note for COGS here because there's a few different cost flow assumptions for how we calculate COGS. So first in, first out, this is assume that whatever we purchased first, so the very last thing that we've purchased is going to be the first out. So that's just kind of saying, okay, we bought, you know, a sweater for $10 20 years ago, or whatever it is, and then that's going to be the first one that we track. That price of that cost of goods sold is going to be the price that when we sell it, we're going to associate that cost with that item, versus last in, first out is the most recent one. That's the cost of the product that we're selling. And then average cost is going to be in the middle of the two. And this is basically saying, okay, you take how each of your units, how much did it cost, what's the cost associated with all those units, add those up, divide it by the amount of units you had, and that's just your average cost. So it's the same kind of on each time. And then we also have specific identification for just more unique specific stuff. So like for example, art dealer paintings could kind of have very unique specific costs. So you don't want to kind of average that out, just because it could vary a lot, but have the same product. And so you can just see here the difference if we're buying these rubber chickens, because I love rubber chickens. They're really cool. I prefer chickens that I can eat too. But as you can see, the costs of these items have been increasing. So if we're doing kind of first in, first out, we're going to be using the lowest cost versus last in, first out. We're using the highest cost. And then average is going to be averaged out. So it's going to be somewhere in the middle there. And then speaking of costs, we'll get to that. But one thing just to keep in mind is that because first in, first out is using the most last purchased one, it's not affected by it's not affected as much as kind of what the prices are doing right now, versus last in, first out, it is affected that much, which means that since it is affected more by, let's say, price increases, if you're doing a perpetual inventory system, your COGS is going to be different, because if you're constantly tracking and the price is constantly increasing, it's going to be higher COGS, as opposed to doing a periodic where you kind of wait until the end of the period and then calculate it. And this is just for like very variable prices. It's super niche. Just keep that in mind. And then one more thing is each different kind of inventory cost flow assumption is going to have different COGS, and that's just the nature of how it goes. But if you combine that with kind of the overall inventory, your overall inventory is going to be the same. It's just whether or not the COGS is going to be different. So like we were talking about inflation, if you're in periods of inflation where the prices of things are increasing and you're using first in, first out, then you're going to be using the cheaper items, which means the cheaper cost of items, which means your COGS is going to be lower. Opposite for last in, first out, and then opposite as well for deflation. And then again, it doesn't matter if prices are rising or falling. your average cost is going to be somewhere in the middle of those two. So what happens if we make a mistake? Because accountants apparently make a lot of mistakes. So any error in these factors is going to flow through. So we kind of just think about these different equations, and they're all going to flow into each other. So our COGS flows into our expenses, and then our expenses are part of our net income, which flow into our retained earnings. So keep in mind how those are all infecting. And then also just keep in mind the symbols of it. So any error in our, let's say, ending inventory. Let's say we overstate our ending inventory, so that's going to be higher than we think it is. And since that's a negative sign, that means our COGS is going to be lower than it is. And then we take that lower, bring it down to the expenses, means our expenses are going to be understated. And if that's understated, again, we look at that sign. It's a minus sign, which means on the equal sign, it's opposite. So that means our net income is going to be greater than. And then we bring that down to our retained earnings calculation, and if you see there, it's a positive sign, which means it's going to be the same. So that means net income overstated, retained earnings overstated. So what I have to do to keep in mind is these equations, right? So how is COGS calculated? How is net income calculated? How is retained earnings calculated? And then just know which signs is associated with which term, and then you'll be able to follow through the flow of what's overstated, what's understated. But what's really cool is for inventory errors, they correct themselves after 2 terms, because that way you don't have to fix anything, so it's easy. So essentially what happens is, let's say our ending inventory is overstated. That means our retained earnings is going to be overstated. But then since our ending inventory for period 1 was overstated, that's going to flow through to our beginning inventory, which is also going to be overstated. And then if we go here with our beginning inventory, that's going to increase our COGS, and then it's going to be the flip side, which means that retained earnings will be understated, which will balance out from the first period. So basically, if you make a mistake in inventory counting, just like wait out for a period and it'll fix itself, which is pretty cool because it saves you effort. Okay, so then going through to some expenses. These basically are going to decrease shareholder equity because they come from either purchases or operations of generating revenue. And one of these important things is called the matching principle, which basically means that you want to like match up the expense when it has occurred. So you're either tying it to a product cost, so COGS, or periodic costs, things within your operations like selling, general and administration costs like that. So there's kind of the 2 different general expenses. You want to match that up. And then the conservation principle is essentially you only record anticipated gains when you get them, but you want to record anticipated expenses as soon as you can, immediately. Just give a more accurate reflection of what the business is doing, how it's doing, how well it's doing, and not overstate like your inventory or your assets. So one thing to keep in mind, one of these expenses is, well, what happens if we bought stuff and then the price of that goes down? So basically our net realizable value is the amount that can be obtained from the sale of our inventory minus how much it will cost for us to sell all that inventory to everyone. And let's say we purchase something for $1,000, but then the NRV drops below that. That's going to be a loss, and we want to record that expense as soon as we can to accurately reflect what we have in stock. So let's say for Labubus, because we all love Labubus. Let's say we bought them for $1,000 when they're super hot, but now they're worth like $1. We don't want to say, oh yeah, we have $1,000 of Labubus. That's wrong. So we have to record that that loss there as an expense, and the book value of that is going to be the minimum between either the historical cost, in this case for the Labubus, would be $1,000, or our net realizable value, whichever one's lower. In this case, we made a bad investment with the Labubus, lost a bunch of money. Okay, another part of these expenses is called allowance for doubtful accounts. Basically, not everyone's going to pay you, unfortunately. It's how that's the way the world works. So you kind of estimate, I think like this amount of people aren't going to pay me, and then you record that expense beforehand, and you add that to this thing called allowance for doubtful accounts, and then you also add it to this thing called bad debt expense. And allowance for doubtful accounts is going to be a contra asset to accounts receivable. So once again, contra asset flipped of the normal credit and debiting. and it's basically just things that are probably going to be uncollectible in the future periods. And then you want to record this as an expense. Just kind of keep track of how much money you're not collecting, and this temporary account is an expense. Just kind of monitor throughout the period what's not been paid. So how do you set this up? So first you're going to estimate it, which we'll get to kind of the different estimating messages, and then find the existing balance. So whatever the current existing balance, you're going to have that, and then you're going to kind of add in what you've estimated. So in this case, you think it'll be $8,000, and then once you kind of have, okay, this allowance for doubtful accounts is going to be $8,000, you're also going to add that to record it as bad debt expense. So like how we said, you're going to debit bad debt expense to increase it, and then credit allowance for doubtful accounts because it's a contra asset, and that's going to balance out. And that's the only time that you touch bad debt expense. So if you think 1% of 800,000 is going to not pay you, you'll be adding that to your bad debt expense and your allowance for doubtful accounts. And then you never touch bad debt expense again. The only thing you're going to touch if things happen is your allowance for doubtful accounts, and we'll get into why you're going to touch that in a bit. But two different ways of calculating your allowance for doubtful accounts. One is just based off a percentage of receivables. You have $100,000 of receivables, and you think 3% of that is going to be uncollectible. You just do that quick calculation and see what the allowance for doubtful accounts for you is, or you can do it based off how old accounts are. So the older an account is, the higher likelihood they're not going to pay. Maybe they forgot, maybe they just don't like you. Doesn't matter. They're just not going to pay. So you kind of increase the percentage based on how long it's been. And then for aging of accounts, you're going to take that. So let's say however many accounts you have in 1 to 30 days due, add that up, times that by the percentage, and then do that for all of the different time frames, and then add up all of those. And that's going to be your allowance for doubtful accounts. Okay, so when you're recording this, I kind of went through this already, but this is, let's say you know for certain that something is not going to be collected. It's no longer an estimation, you know for certain. So what are you going to do? One, you're going to reduce your allowance for doubtful accounts because you're like, okay, I estimated this, boom, I was right, I got to reduce that. So that's where you see that $3,000 on the left there. So you have that, but then you also know, okay, they're not going to pay me, I lose that receivable. So then you're going to decrease your accounts receivable by that same amount to make sure they balance out between debits and credits. And you see here, we don't touch the bad debt expense. I know that's like a lot of words, but basically when you know for certain that they're not going to pay you, you're going to reduce your allowance for doubtful accounts, and then you're also going to reduce your accounts receivable because you no longer have that IOU. It hurts. And then basically just, let's say you estimated it to be 6%, but for some reason all of your suppliers sucked and no one paid you, then your allowance for doubtful accounts ending balance is going to be very different than what you expected it to be, which means in the next period, you're going to change your guess. You're going to change your estimation, and hopefully this time it'll be a bit better. So that's just kind of what this is saying here. Going just a bit into inventory turnover, two different things. One is just inventory turnover. So this is basically like throughout a period, how many times did you go through all of your inventory? And so this is taking your COGS divided by your average inventory, which is your beginning and end inventory divided by 2. And that's your average inventory. And then you can do this on kind of a daily streak or per day. And this is essentially saying, okay, how many days does it take to turn over inventory on average? And there's the calculations there. And then on the other side, we have our accounts receivable turnover. So again, we were going through, if someone takes 5, 10, 30 days to pay you, how long does it take to collect that cash? And this is your total amount of credit sales, and then your beginning accounts receivable, ending accounts receivable divided by 2 for your average accounts receivable. And that's going to give you this number. And once again, we can find what's the average time it takes to collect cash by just doing 365 divided by our account receivable turnover. And that just gives us kind of a nice picture of, okay, on average, how long does it take to get our money from the people who owe us money? Hopefully, not that long. But then for inventory, we want that to kind of be faster. So that way we're going through our inventory faster, which means we're selling more items and we have less on stock, which can be impacted by inflation. So yeah, higher accounts receivable turnover means that it takes longer for us to, a higher average collection period is worse because that means it takes longer on average to collect our receivables from the people who owe us money. And then just an operating cycle, think on two parts. One is me selling something, that takes time, and the other is me collecting money. So you add those two together, and that's your operating cycle. So that's basically how long you can kind of rotate through operations. One takes me a few days to sell my items, to get them off my inventory, and then it takes another few days for me to collect that money from people. Add those two together, so your day turnover and your collection period, boom, that's your operating cycle. That's all it is. And last thing, just a little bit of a carbon accounting, just to explain a little bit. So you have three different types of scopes. One is the direct emissions. So this is basically like a factor that the company controls. As a factory, it's producing a bunch of smoke. That's gonna be in scope 1. Scope 2 is gonna be indirect emissions. So this is like the electricity that you pay for heating, cooling, your offices, things like that. And then your scope 3 is your indirect emissions. So essentially this is gonna be from its value chain. So your suppliers, their fuel costs, their emissions, everything like that. And so just kind of keep those three definitions in mind. And then depending on the industry, depending on the company, some will have way higher scope 1 emissions, some will have way higher scope 3 emissions. It really varies. And then when you're calculating emissions, you're going to take your activity. So it could either be in, just give you straight up the kind of greenhouse gas emission equivalent, or it could be in dollars, and then you're going to times that by this emission factor, which is basically like, okay, per kilometer of air travel, what is the total emission, and you just multiply that by the coefficient, and that's going to equal your total emissions from activity. And that's pretty much all carbon accounting is, just multiplying those two coefficients and then keeping in mind what the different scopes are. And that is everything that we've covered so far. I know I went through it a little bit quick. I hope you were able to follow along and everything made sense, but that's pretty much the basis of all of accounting in under 45 minutes. Thank you so much for watching. If you could please scan the QR code and let us know feedback on these sessions, and then also you can check out our Instagram or YouTube for the slides. We're a UBC Simplified organization dedicated to giving free academic resources for all students, and hopefully, again, we'll be going to some different courses and different faculties soon as well. Thank you so much for watching, and best of luck on your midterm. See ya.